Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is Robert Spendlove to discuss the current economic conditions. Robert, over the past week or so, we've really seen a lot of kind of turmoil both in the bond and equity markets. We've seen the volatility pick up quite a bit. And it really seems to be coming on the back of some pretty solid economic data, especially out of the recent jobs report. Can you kind of walk us through what we're seeing?
Sure, and I think one of the things we need to keep in mind is this is part of a longer term trend that we've been seeing in equity markets, in the stock market, and I really divided into three different parts, and we've really seen what I call inflection points. They were kind of shocks to the system that changed the direction of the market. So the first one happened on election day in 2016, where before that the market had essentially been moving sideways. But then after 2016, we saw the market rising dramatically for the next 18 months. The next inflection point was after the jobs report in February, where fears of inflation had the market turn to more volatility and started to move a little bit more sideways again. Now, since then, we've seen recovery, but once again, the jobs report and some of the economic data has the market spooked again. So what did we see? The last jobs report showed 134,000 jobs, consistent with what we've seen in the past, but we're now at 8 years of consecutive monthly job growth. So really strong job growth. But the big number that everyone was focused on was the unemployment rate. Dropped from 3.9% down to 3.7%. Now that's the lowest unemployment we've seen since December of 1969. So we're talking gas at 35 cents a gallon, moon landing, Woodstock. That's where we are now, is back in December of 1969. So that is significant. The problem with that is the further we go below that full employment level, it's causing more distortions in the economy, it's causing more labor shortages, and here's the fear, is it's starting to cause higher inflation. We just received our latest indicator of inflation, the Consumer Price Index, and we see that it rose 2.3% over the last year. That's above the level that the Fed wants to see, and so there's starting to be increasing fears that inflation is creeping in and the Fed is going to have to start acting.
Right, and talking about the Fed starting to have to act, you know, at the end of September, they went ahead and they raised the target range for the federal funds rate between 2 and 2.25%. But they also kind of signaled some future rate increases. What was it about that report, and what is it about this signaling that may be driving some of this volatility?
Yeah, that's what was really interesting. So the Fed has been on a long-term path over the last several years of raising rates. Coming out of the Great Recession, the Fed dropped rates all the way down to effectively 0% for very short-term rates. But about 2 years ago, the Fed started raising rates again. They usually raise them, at least in the last period, they've been raising them by about a quarter point when they raise them. And they've raised them about 2% now, so the federal funds rate is now just north of 2%. And it was not unexpected. It was essentially priced in. Markets expected the Fed to raise the federal funds rate up to above 2%. What has caught markets a little bit off guard and what they're a little concerned about is not what the Fed did, but what the Fed is saying they're going to do. Right. They've essentially signaled that they're going to raise rates again, probably around December of this year, another quarter point, and then probably 3 more times in 2019. So we could see interest rates 1% higher a year from now than we're seeing today. And what previously the longer term rates had remained relatively constant. They hadn't risen as quickly as the Fed's short-term rates had risen, but that changed last week. And specifically the 10-year bond broke above 3%. 10-year bond is a really important rate because it determines the rate on home mortgages. And so we're starting to see, as that yield curve steepens and catches up with the Fed's increases, it's going to have the effect essentially of slowing down the economy. That's really the goal. You know, the Fed is concerned about overheating of the economy. They're concerned about overheating inflation, and so they're increasing these rates to kind of take the foot off the gas of the economy.
Yeah, and so I know reading a lot of headlines, President Trump has even weighed in. He doesn't think the Fed should be raising rates as quickly as they are. Going forward, do you think those kind of comments are going to deter the Fed in their future rate path? What could maybe cause them to either speed up or slow down?
Yeah, it was interesting that the president's response really to the stock market volatility was he said, the Fed has gone crazy.
Yeah.
Now, I don't think that's true. I don't think the Fed has gone crazy. The Fed is data dependent. The Fed is focused on our economic fundamentals, and they really are concerned about this overheating of the economy. They want to make sure that there's not a repeat of what we saw leading into the Great Recession, where very low interest rates created the bubble that popped during the Great Recession in the housing market. And so they're trying to very carefully kind of take the momentum down a little bit and start slowing the economy. Now, one of the things that markets are worried about, though, is President Trump's tariffs, especially on China. Now, if the president has valid concerns about what China's been doing, but the real struggle is the way that we react to these concerns. Do we carefully work with China to resolve some of the problems, or do we expand tariffs to enormous amounts, essentially putting an extra tax on all Chinese imports, which really is putting a new tax on all products that Americans consume? And that could have dramatic negative impacts on the American economy, and that's something that that investors and traders in the stock market are very concerned about.
Right. Well, Robert, thank you for your analysis. It's going to be interesting to see how some of these trends play out in the longer term.
Definitely.
Thank you. Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.